The Federal Reserve opted not to cut interest rates this week when they met. Now, what does that mean for the average homeowner? The mortgage prices, the home equity lines of credits, the credit cards, those rates are not going to go down. They are going to pretty much stay the same at least until their next meeting. They're set to meet again May the 1st to determine if they're going to cut the rates. Now, they did state that they project to cut the rates 3 times this year. We don't know when that's going to be. However, this committee that meets is called the Federal Open Market Committee. They meet between 6 to 8 times per year to discuss the economy. The reason that they're not reducing the rates at this time is because of inflation. They stated that the inflation is basically not where they want to see it. They want to see it around 2%. Right now, it's at 3.2%, and it has increased slightly in February, higher than January. So they're seeing it going up versus down. And their statements are if they cut rates, we're going to be back in the same situation another year to 2 years. Their whole point is they don't want to cut the rates now because we are going to be in a repeat process. So for those of you who don't fully understand what inflation is, the inflation is the cost of goods and services and how much your dollar can buy you. What's the buying power? Whereas you used to be able to go to the grocery store and let's just say get a dozen of eggs for 99 cents. Well, that's not the case today. That is due to inflation. The cost of things is elevated, the cost of services are elevated, but the dollar has not elevated. So that is inflation. And last year, inflation was over 6%. It's at least half, but it's still not where it needs to be. So until the inflation rate starts to come down, the rates will not be cut. So that is what they're looking at just to make sure we don't have a repeat. Now, they meet again May the 1st, so we'll see what they do at that time. That's just a quick update.